Ben, it's great to have you on the show. Welcome.
Thank you so much for having me.
So it's kind of a tough environment to raise one fund alone. How about two? Why now, and what did you find?
Well, I mean, for us, we've been at this for a while. This is we actually just raised our 8th seed fund and our 4th growth fund, and so this is more of the same, more of what we've been doing for the better part of the last decade. And I think the advantage that we have relative to the not so great late stage market right now is that we're typically first institutional check in any company that we're investing in. And so by the time the companies that we're investing in right now are thinking about exiting, the market will probably have gone from terrible to great to terrible to great several times. And so we really take a very long-term view, are founder focused, and actually feel like investing into a recession at the startup stage is an incredible opportunity.
How is it impacting deal flow right now, all this market volatility?
So early stage deal flow has continued to be strong. It was a little slower over the summer, I think, as people were sort of getting used to this new normal. But we've continued to see incredible opportunities. There's a bunch of people who have spent the better part of the last decade working at a lot of the sort of companies that came out, IPO'd, had incredible runs in the public markets, and maybe have experienced a little bit of or maybe a lot of pain over the last several quarters. And so there's actually lots of talent leaving traditional tech, and folks are starting new companies, and I think that's going to benefit the early stage market. The reality is in the later stage right now, pre-IPO rounds, CDE rounds, those are largely shut down. I think that late stage investors are trying to figure out where pricing sort of like what the is relative to the public markets.
That's what I was going to ask you about pricing and valuations, because we got this deal last week, Adobe buying Figma for $20 billion, a company of 50 times revenue, valued at, I think, double what it was valued in 2021, which makes you wonder what's happening with private valuations and whether they have some catching up to do with the public market.
Well, look, I think that, Figma is an example of an extraordinary company built in the private markets that I think probably could have gone public if it had wanted to, but obviously had a bunch of strategic reasons to partner up with Adobe. Where the sort of delta between public and private markets, those multiples have fluctuated a ton. Last year, I think you saw all-time highs in both the private and public markets. Obviously, with the public market drawdowns, the private market, has felt multiple compression. That has happened much more at the later stage. In the earlier stage, we've seen pricing come down from sort of highs of last year, but not close to the way that you've seen public market valuations change. And I think that's because it's proven itself to be clear over the last decade that early stage venture capital is a great asset.